Hello everyone, welcome to Easy Economics. How are you all doing? I hope you all are doing good. Today I brought for you all a topical series in which the topic we are going to be doing today is foreign exchange rate. I had been receiving a lot of requests in which you all wanted me to explain the topic. So I've broken down this topic into two parts. In the first part, we'll be dealing with what is foreign exchange rate, what is a floating exchange rate, what is a fixed exchange rate, and who buys and sell currencies. The second part will be looking at why does these exchange rate fluctuate, what's the impact of these fluctuations, and finally the advantages and disadvantages of both floating and fixed exchange rate. All right, so let's begin with the topic. Exchange rate or foreign exchange rate, by definition, refers to the price of one currency in terms of another. So when you're expressing one currency in terms of another, that's when you call it an exchange rate. That means how much or what's the value of a currency in terms of another. For instance, how much is $1 equivalent to? So I have to give 280 Pakistani rupees in order to buy $1. Or I have to have $80, 80 rupees that would be converted and it would yield me 1 Saudi Riyal. So this is how when a currency is expressed in terms of another, that's when you call it an exchange rate, right? So if they ask you for a precise definition, a foreign exchange rate index is the price of one currency in terms of a basket of other currencies weighted according to their importance in the country's international transactions. So you see, if we are talking about Pakistani rupee and the index is the Pakistani rupee index, so what are we talking about? We are talking about how much would Pakistani rupee be against Saudi Riyal, against dirham, against the pound sterling, against renminbi, against Riyal, against Euro, against Japanese yuan. So that's when we are talking about in terms of a basket of other currencies. Now, how much weightage is given to each currency depends upon how much that country deals with the other countries. That means it depends upon your international transactions, how much of imports and exports of goods and services, the activities involved in international trade that requires the exchange of currencies is being done, right? So the larger the activities, the more weightage would you give to that particular currency. So it depends upon the international transaction that country has with the other country. All right. So broadly speaking, there are two types of exchange rate. The first is a fixed exchange rate. The second is a floating exchange rate. Now, by definition, the very term fixed is telling you what? That this is the exchange rate whose value is fixed or set at a particular level. So it's at a particular band or a range in terms of other currency or currencies. Again, this value is fixed by whom? The government, usually the central bank, and it's maintained. So in order to ensure that the currency remains within that band, the government does a set of transactions, does a set of activities in order to maintain it. So the value is set at a precise price or within a given margin. If the market forces are pushing the value of the currency down, then the central bank will step in and seek to increase its value either by buying the currency or increasing the interest rate. So now what's going to happen? Now let's suppose the value of a currency is going down. It's decreasing within the prescribed band, whatever the range was, it's falling below that. So the government would step in and would buy back the currency. So that what happens? The supply reduces. So once the supply of the currency reduces, automatically the price would pull upwards. Or alternately, what it could do is it could increase the interest rates. So when the interest rate would increase, what would happen? The demand for that currency would increase. So when the demand for currency would increase, what happens? The exchange rate is automatically going to go up. What happens when the demand increases? The price pushes up, right? Or when the supply reduces, what happens? Again, the price pulls up. That's the same strategy adopted in this scenario in order to pull back the exchange rate back to its initial set price. Get my point? I'll explain it to you graphically as well. Before that, let's look at to what do we call when there's a fall in the value of the exchange rate. When it comes to fixed exchange rate and there's a fall in the value, we call it devaluation. A fall in the value of a fixed exchange rate is called devaluation, and a rise in the value of a fixed exchange rate is called revaluation. It could come as an MCQ or a one marker in your data response questions. Alright, let's look at case 1 under fixed exchange rate. Let's look at the first diagram. The vertical axis displays the price of dollars in pounds. That means how much is $1 in terms of pound. So that means what was the fixed exchange rate? $1 was equal to 3 pounds. Now what happens? The demand increases such that now $1 is equivalent to 3.5 pounds, right? Now it's rising beyond the rate that was set. So what does the government do? The government has started selling dollars. Notice in the second diagram, what happens? That the government starts to sell dollars. Why? So that the price falls back to the set range, which was $1 was equivalent to 3 pounds. Case 2, this is what we had just discussed. What happens? If the demand for dollar is falling beyond the range of $1 was initially at what? 2.5 pounds. This was the initial position. Now what happens? Let's say the demand is falling. Right? The demand is falling. Maybe let's say the interest rate fell. Or maybe let's say the exports of that country is falling. Right? So let's say US exports are falling. So what happens? The exchange rate is falling. So when the exchange rate is falling, but the government wanted to what? Have it at the prescribed set range, right? That was 1 pound was equivalent to $2.5. But now because of the fall in the demand, it's falling beyond 2.5, right? It's falling below 2.5. It's falling to 2 pounds. So in order to bring it back, what would the government do? The government bought back dollars. So notice in the second diagram what happened? That the supply shifted inwards, right? So when the supply shifted inwards, notice this is again where the equilibrium position was restored back to 2.5 pounds. $1 was equivalent to 2.5 pounds. So this is how the exchange rate reached its original rate. Alright. Now let's look at the second type of exchange rate, which is floating exchange rate. Now it's exactly opposite to fixed exchange rate. A floating exchange rate is an exchange rate which can change frequently, or it is determined by the market forces. The fixed exchange rate was determined by whom? The government is a central bank. But Floating exchange rate is left on the market forces, which is determined by the market forces. Now what happens? If the demand for the currency is increasing or the supply of the currency is falling, what happens? The price of the currency will rise. If the demand increases or the supply falls, what happens? It should automatically pull up, right? The price of the currency will increase. Such a situation will be called what? Appreciation. When we are talking about a floating exchange rate and we are experiencing a situation in which either the demand for a currency increases or the supply of the currency falls, causing the currency value to increase, the price of the currency to increase in terms of another, such a situation will be called what? Appreciation. Right? Or, in other words, a rise in the value of a floating exchange rate. So, how would you define depreciation? A rise in the value of a floating exchange rate. However, if the demand is falling or the supply is increasing, so the price of the currency will what? Fall. The demand is falling and the supply is increasing. So automatically what happens? Under free market conditions, what happens? The price of the currency is going to fall in terms of another, right? So such a fall will be called as depreciation. Or in other words, how would you define it? A fall in the value of a floating exchange rate. So if it's a rise in the value of a floating exchange rate, that's called appreciation. And if it's a fall in the value of a floating exchange rate, that's called depreciation. Right? But what about the fixed exchange rate? What had we called it? Yes. Devaluation and revaluation. Don't mix the terms. Be very clear in your concepts. Alright. So now, let's look at this diagram. Initially, this was the position. This was the demand of pounds in US dollars, right? And this was the quantity of pounds. So the vertical axis shows how much was 1 pound in terms of dollar. Now what happened when the demand rose for pounds, automatically the exchange rate rose, right? And the quantity traded also rose. So now notice nothing is being done in order to restore it back. Why? Because it's a floating exchange rate. It's allowed to freely float without any government or central bank's intervention, right? It's left on the free play of the market forces. It's left on the demand and supply conditions of the market. So now the question which arises is, who buys and sells currencies? The question which now arises is, when you're talking about exchange rate, who actually needs these currencies? Why do we actually deal in currencies? So central bank, individuals, firms, and commercial banks, they all either buy or sell these currencies. Now, why does the central bank does that? Because it needs to have reserves. It needs to pay deals in international transactions, right? For the balance of payment, right? For the current account. Individuals need to pay for their imports and export payments. Similarly, firms need to do that for their foreign direct investment, right? Or again, for their international transactions. Similarly, commercial banks need to do that in terms for their customers, right? Or in order to deal for transactions or for currency conversions or for payment of interest, right? All right. Now the question arises, why are currencies bought and sold? So what are those transactions? Can we define that? Yes, we need it for speculation. We need it for demand for imports and exports. We need it for purchase and sale of financial assets. And we need currencies for foreign direct investments carried out by multinationals. Right? All right. So here there's a key term, foreign direct investment. Can anybody tell me what do I mean by foreign direct investment? Yes, foreign direct investment is when a production unit is either set up or bought in another country, right? Usually MNCs do that. All right. Now, let's look at why would there be a demand for pounds and why would there be a need for supply of pounds? Who would be demanding pounds or why would be needing pounds? For what reasons? And again, how would the supply of pounds be made? Or why would we need that? Or what transactions would be leading towards the supply of pounds? It could be for any currency. Here, for example, we have chosen the pound sterling. So for the demand for pound would be made by speculators. Why? When they are buying pounds in expectation that it will increase in value in future. So if speculators believe that in the near future, pound is going to rise in value, so they are going to be demanding it. Or foreign governments who wish to keep pounds in their reserve, they would be demanding pounds. Or firms who wish to buy UK firms or who wish to set up their production facilities in the UK, they would be demanding pounds. Similarly, UK residents who are receiving dividends on shares by foreign firms or Britishers who are working abroad and they're sending back money home, they would be demanding pounds to convert their salaries, convert them back into British pound and send it back home. And how would the supply of pounds be made? Again, speculators who are selling pounds. Why? Because they think that in the near future the price of pounds is going to fall, so they want to sell the pound sterling and buy some other currency instead. Or the UK government wishes to keep other currencies in their reserve, so they would be selling pounds and buying, let's say, euros or dollars or yuan. Third, it could be UK firms and individuals. They wish to buy shares in foreign companies or save in foreign banks and lend to foreign firms. Or it could be UK firms who are paying dividends on shares held by foreigners. So if there are firms who want to pay their foreign investors their share of dividends, so they would be converting pounds into their relative respective currencies and giving it to foreigners. Again, foreigners who are working in the UK and they wish to send back money home, they would also be selling pounds. Similarly, who would be selling pounds? Britishers who are buying foreign goods and services. So if they are want to pay for their imports, they would be converting their pounds. Or UK banks who are selling pounds on behalf of their customers and they are paying interest on money when foreigners have it, right? Who are living abroad. Or MNCs who are working in UK and they are sending back profits back home. So they would be converting the profits generated in pounds back to their home currencies and send it back to their countries back home, or it could be repatriation of profits as well. Similarly, what about the demand for pounds? The demand for pounds would be made by foreigners who are buying UK goods and services, right? Or it could be by foreign banks buying pounds for their customers and paying interest on money held by UK residents, or foreign branches of UK MNCs sending back profit to UK. So if there are certain UK firms in other countries and they would be sending back profits to UK. So they would be converting their currencies and demanding pounds in order to send back profits home. So these are the international transactions for which we would be requiring demand and supply for pounds. I hope so far it's clear. We'll meet in the second part of this chapter. Stay tuned, subscribe, happy learning.